Hey, financial accounting students. Today we're going to learn how to use the double entry accounting system. So far, we've been recording a lot of business transactions using the accounting equation format, but today we're going to upgrade those skills and learn how to use T accounts and use debit and credit terminology. So first, when it comes to debit credit terminology, I want you to erase everything that you know about debits and credits from banking or from your debit card or for your credit card. Forget all of that because how we use debit and credit in accounting is a little bit different. The words debit and credit simply mean increase or decrease. Well, of course, you want to know which one means increase and which one means decrease. Well, it depends is the answer. So let me show you real quick. It depends on which side of the accounting equation we're talking about. So if I have my accounting equation, assets equal liabilities plus owner's equity, the words debit and credit mean opposite things on opposite sides of the equal sign. So on the asset side, debit is an increase. On the liabilities and equity side, debit is a decrease. When it comes to credits, on the asset side, a credit is a decrease. But on the liabilities and equity side, credit is an increase. So what we see is that they do opposite things on opposite sides of the accounting equation. And if you can picture the accounting equation moving up and down, so if one side of the equation goes up, if our assets are going up, that would be a debit. And as the liability and equity side, it has to move in the same direction because the equation always has to be in balance. We can't have the equation out of balance. So to increase the liability and equity side and maintain balance, we have to have a credit. Let me show you how I remember the rules of debits and credits. So here's how I remember it. And there's lots of different ways that people learn this, but I use this little mnemonic device, aid and lick. And all that means is assets increase with a debit, while liabilities and owner's equity, the whole liability owner's equity side of the equation, increase with a credit. And I always like to throw in at the bottom a big equal sign because on every transaction and in total, our debits have to equal our credits. Everything has to remain in balance. So as our assets go up on the left side, then our liabilities and equity also have to go up on the right side. So that would be a debit and a credit. That would be an asset source transaction. If we have an asset use transaction, then our assets would be going down, and that's a debit. And therefore, our liabilities and equity would also have to go down, and that would be a debit. So in every transaction, the total value of all debits needs to equal the total dollar value of all credits. So this equality combined with ALLO, assets equal liabilities plus owner's equity, forces this constant balancing in our accounting transactions and in our financial statements. Here they're showing our debit credit terminology in the form of T accounts. Now, when we talk about T accounts, it's not really a mystery why they call it a T account, just because it's shaped like a T, that's all. There's nothing more to it than that. But the most important thing to learn about T accounts initially is that the debits are always on the left and the credits are always on the right. So debits are on the left, credits are always on the right, no matter what. Doesn't matter if it's an increase or a decrease, debits on the left, credits on the right. When it comes to recording our transactions, we want to walk through it in a three-step approach. So first, we're going to determine how the event affects each element of the accounting equation, meaning what's going to go up and what's going to go down. Are assets going up, liabilities going up, what's happening to the accounting equation? And it's best if you can just explain that in your own words using things like goes up, increase, decrease. Then step two, then we want to use the rules of debits and credits to convert our common terminology into debit credit terminology. And then finally, we need to make sure that we're identifying the specific account title. So not just assets, but specifically cash or accounts receivable, not just expenses, but rent expense or salaries expense. So we need to make sure that we're practicing identifying the correct specific account title. And then that will relate to recording those debits and credits into their specific T accounts. So we're going to look at just a couple transactions for Collins Brokerage Services. To start with, they give us these beginning balances. It says January 1st, year 2, beginning balances for the permanent accounts are as follows: cash, $5,000, common stock, $4,000, and retained earnings, $1,000. Now, as you read that, did you just automatically assume that all of those are positive numbers? That we have positive $5,000 in cash, positive $4,000 of common stock, and positive $1,000 in retained earnings? That's pretty normal to assume that they're positive, and that's a good assumption to make. When they give us beginning balances, it's what we call a normal balance. So the normal balance is whatever we have to do to increase the account. So when we read cash 5,000, well, we know to increase an asset, assets increase debit, that would be a positive number, and therefore it would be on the debit side of the T account. For common stock, that's an equity account. And when they tell us that we have 4,000 in common stock, we assume that that is a positive 4,000, and therefore that is on the credit side because liabilities and equities increase with the credit. And again, I could say the same with retained earnings. We assume that that's on the credit side because we assume that it's positive. So that's the concept of normal balance, that we are to assume that something is a positive number unless we're told otherwise. And to figure out what that normal balance is, it's whatever we do to increase the account. Now, of course, the temporary accounts, the revenues, expenses, and dividends, have no beginning balances because they get closed out at the end of each period. So we're going to look at just one transaction together, and then I'm going to have you try a few on your own. So first, event 1, on January 1st, year 2, Collins acquired $25,000 cash from the issue of common stock. So if we follow the three-step process, first, we just want to think about what's going up, what's going down. So we're getting cash, so it sounds like assets are going up. And it was from issuing common stock, which that sounds like equities going up. In terms of debits and credits, if we have an asset that's increasing, that's a debit. And for common stock, that's an equity. And therefore, that's a credit. So our debits equal credits. And we can see here in our T accounts, we've got a debit of 25,000 and a credit of 25,000. So debits equal credits, and also an accounting equation format at the bottom, we see 25,000 equals NA plus 25,000. So our ALO is in balance as well. Let's see if you guys can try the next few transactions on your own, and we'll check back and see how you're doing.